NASDAQ 100 basically flat, but it's masking a bit more strength underneath the equal-weighted S&P, up about 0.5% today. We begin with our talk of the tape, with economic growth revised higher for last quarter this morning, alongside prices easing and Treasury yields breaking down toward a 3-month low. Are we back to pricing in a soft economic landing as the base case? Let's ask Greg Branch, Veritas Financial Group managing partner and a CNBC contributor, and Kristina Hooper, Invesco's chief global market strategist. It's great to have you both here. Thanks for coming by. Greg, I know you're going to have a little bit to argue with here in terms of how the market is seeing things, right? I mean, this last leg higher in stocks started with the CPI report, really, November 14th. Right. Kicked us higher. That got 10-year Treasury yields below 4.6. Now we're under 4.3. It seems as if the Fed kind of done, and yet the economy holding up. What's wrong with that?
Well, I think for one thing, the Fed is screaming from the rafters that they're not done to us. And so I'm going to quibble with that. And I'd even point to the start of this even earlier, but similar to the CPI, where the market started to extrapolate a data point as a consistent linear series. And we don't have that. And so I think it started with the job report. And while 150 or 180, however you want to call it, is not August 297 or September's 227, it's also not June's 105 or July's 157. And so to extrapolate that that's a trend and that we're going to have continued further weakening in the jobs market, I think is a misnomer. I don't think we can do that when it's jumping around like that. So too the CPI. And so I think you've seen a coordinated effort from the Fed to say we're not thinking the way you market is thinking. Mm-hmm. And I think they have some other unforeseen headaches that they haven't announced to us yet. But
well, let's get to that a little bit, because yesterday, of course, the market really took heart in Christopher Waller, Fed governor, essentially saying policy's in a good place. Maybe if the conditions line up, we'll be cutting rates. But we did want to hear what Barkin had to say today. Thomas Barkin, who's not a voter but did speak today, maybe a little more in tune with you, Greg.
There's no particular need to do anything with interest rates if inflation is coming down. But if inflation is going to flare back up, I think you want to have the option of doing more on rates.
So there's you want to have the option. Maybe we'll have to if inflation doesn't cooperate. But, I mean, it seems as if the market's able to look at the inputs of inflation, or at least right now is getting more comfortable with the idea that it's in the trend we want to see.
Right. And the market is. I just don't know if the Fed is. And I think that that's setting up for a negative surprise. Look, we know that they want to see further weakening of the labor market. We know that they want to see continued disinflation. The things that they're not telling us that they've wanted to see is they wanted to see yields in and of themselves continue to rise organically and do some of the tightening for them. They wanted to see expectations remain anchored, and they're slowly becoming unanchored. We're reaching levels we haven't seen in a decade on the long run, up at 3.2% now, and on the short run at 4.5%, which is much different than the Fed's projected 2%. And lastly, when that base effect starts to become more unfavorable, as it will continue to do, we won't get as much psychological comfort from that headline number. The markets won't be able to take as much psychological comfort from that headline number.
Kristina, where do you come down on that, on this idea that maybe the bond market is either overshooting with yields coming down this much, or does it make sense given the data we have?
Oh, it absolutely makes sense given the data we've seen and, quite frankly, what I think the Fed plans to do. As Waller said yesterday, we don't need any kind of significant increase in unemployment. The trigger can simply be disinflation continuing. Now, I agree, Greg, that last mile is going to be harder, but we are getting there, and I think there's pretty significant confidence among Fed members. What we heard from Tom Barkin in that quote was, we don't want markets to get ahead of themselves. We don't want financial conditions to ease, so I'm going to throw in that spoiler to keep you all guessing. But the reality is the Fed is done, and I think that we're going to start to see cuts beginning in the spring of 24.
If that's what he wanted, he didn't really get it today, right? I mean, in terms of what the bond market has done in response to that.
Yes, but certainly the Fed, there's a number of different FOMC members that can be rolled out over the course of days that can try to talk down markets. But I think that's simply what is being done, is being talked down.